Good afternoon and welcome to this week's edition of The Last Word. I'm your host, Peter Milios. It's the end of another week and today I'm joined by Winston Sammut from Euree Asset Management. We're here to review the past week and take a look at what might be on the horizon. Welcome, Winston.
Thank you. Glad to be here.
It's been a tough week for the global equity markets. Despite last Friday's strong close for the month following the key inflation print, the PCE, that aligned with economists' expectations, all three major indexes, the Dow, the S&P 500 and the Nasdaq, posted their worst performance on Tuesday since the global sell-off on August 5th and continued to fall out throughout the week. Winston, what as you see it spooked the US markets this week?
The data that came out, the key driver this week was a combination of factors. First, we had lingering concerns about inflation and economic growth, especially in light of the recent manufacturing data that indicating a slowing activity in the US economy. Additionally, Nvidia, which has been a big high flyer, a key player in the tech sector, saw some selling pressure after its strong run earlier in the year, which further dragged down semiconductor stocks. Lastly, September has a reputation for being a weak month for equities generally, historically, and that seasonality might have played a role in the negative sentiment. Investors seem to be adopting a more cautious stance ahead of key economic data releases, and then they're reacting to whatever the release is, either positively or negatively.
So there has been a lot of chatter this week about the negative September seasonality. Obviously, over the past 10 years, it's been the worst performing month for the stocks, coupled with the fact that the presidential election year brings October headwinds. Investors are now turning their attention to the first major economic release of September, that US government August jobs report due out later today. Are we expecting any surprises?
Well, there could well be surprises, but the market is definitely on edge ahead of the jobs report. There's always the potential for surprises, but current expectations are for a moderate increase in jobs. If the report comes in much stronger than expected, that could reignite concerns about the Fed needing to keep interest rates elevated for longer, which could weigh on markets. On the other hand, if the reports show weakness, it could ease some of the concerns, but also raise worries about a potential economic slowdown. It's a fine balance, and any deviation from expectations could spark volatility.
So commodities, they've also had a tough week. Oil prices plummeted to their worst levels in over a year. This has been largely driven due to weakening global demand, especially with the downbeat economic data from major oil producers or consumers like China and the US. The recent sell-off has been further fueled, pardon the pun, by the potential resolution of the power struggle in Libya, which is expected to increase the oil supply. Oil prices have now erased all their gains for the year. What's your take on the oil market?
Well, you raise a good point in terms of supply and demand. We've seen a significant drop in oil prices, and it's primarily due to the demand concerns. China's economy is slowing down in particular. It's been underperforming, and that's weighing heavily on oil demand. The situation in Libya could further add to supply, which is already pressuring prices. However, I don't think this is a long-term issue. If global demand stabilises and we see some resolution to China's economic challenges, we could see a rebound in oil prices, but for now, the market is reacting to the near-term supply-demand imbalance.
And lithium, once a hot stock, also made some headlines this week. Citibank revealed that the Greenbushes, a lithium mine in Western Australia, is the only profitable lithium mine in the country due to its low operating costs. Citibank also mentioned that Greenbushes can withstand the recent decline in lithium prices. The UBS has also warned that the lithium sector could face a wave of mine closures if prices remain low. How do you see the lithium market playing out?
The lithium market is in a bit of a transition phase right now. Demand for lithium, particularly for electric vehicles, remains strong, but we're seeing some pricing pressures due to an increase in supply. Greenbushes is in a unique position because of its low cost structure, which is important, but many other mines may not be able to weather the current pricing environment. If prices stay depressed, we could see some consolidation in the sector or potential mine closures, as UBS has warned. Longer term, though, the demand for lithium should support the sector, especially as the world continues to transition to renewable energy and electric vehicles.
And Winston, let's shift to the domestic markets. This week, Australia's GDP print showed a modest growth of 0.2%, following a similar increase in the previous quarter. While this fell slightly short of the market forecasts, it does align with the RBA's goal of slowing the economy to curb inflation. What's your take on this, Winston? And what do you expect from the upcoming employment report and the RBA policy meeting?
The GDP number certainly reflects the RBA's deliberate attempts approach to cooling down the economy while controlling inflation. It's a modest growth rate, but it's in line with the bank's target. Looking ahead, the upcoming employment report will be crucial. If the labour market shows continued strength, the RBA might be hesitant to cut rates in the near term. However, any signs of weakness could provide the central bank with the room to ease policy. The key focus for the RBA is inflation, and they'll be watching closely to see if wage pressures are feeding into broader price increases.
Also, the big news of the week came from Australia's hot week of corporate transactions. What can you tell us about these hot M&A deals?
Australia's M&A market experienced a record-breaking week in September, with several major deals announced. Notable transactions include REA Group's consideration of a takeover of Rightmove, Macquarie and a Canadian pension fund's acquisition of AirTrunk for a big price, and Aurora's sale of its US packaging business. Blackstone emerged as the winner in the $24 billion auction for AirTrunk, making it the largest M&A deal of the year. The AirTrunk deal alone contributed significantly to the overall deal volume, surpassing previous records.
And looking ahead to next week, what are you expecting in terms of market direction?
Well, next week could bring a bit of relief rally if the economic data comes in as expected. The jobs report, which is due out tonight in the US, shows moderate growth. If it does show that moderate growth and inflation remains under control, we could see a more positive sentiment returning to the markets. That being said, we are still in a period of heightened volatility, so any expected developments could quickly shift market direction. And as you mentioned before, September is a bad month historically, so we'll see how we go.
Winston, thank you for your time.
Pleasure.
We'll be back next week for another edition of The Last Word. Thank you.
Thank you.